Good morning, everyone, and I hope you're enjoying our virtual conference week. Welcome to this session on our accounts rules. So we ran this session last week at our live compliance officers conference, but we want it to be as interactive as possible. So what we're going to do is rerun it today live so that we can get lots of questions and answers from you. So just to introduce our panelists today, I'm Liz Rosser. I'm the Executive Director of Resources at the SRA, and I'll be asking your questions for you. And I'd like to introduce Sean Hankin. Sean is Head of Forensic Investigation and Intelligence at the SRA. Sean actually was one of the authors of the accounts rules, and it's his team that checks for compliance with the rules and also reviews any qualified accountants reports that are submitted to the SRA. And I'd also like to introduce Janet Taylor, who is a partner at Taylor Mowbray LLP and a consultant with PKF Francis Clark. And Janet will be providing the perspective of the reporting accountant, and she also trains staff in law firms and reporting accountants on the rules. So we've got some real expertise here for your questions today. So as I say, it's going to be a question and answer session. I've got plenty of questions to start us off, pre-submitted questions, but there's going to be plenty of time to take your questions. So, sorry, just adjusting that so I'm not getting too much interference. Hope that's okay. So there's going to be plenty of time for your questions as well. It's always nice to know your name, so you can submit the questions anonymously, of course, but if you would like to, please do add your name as well. And also just a little reminder that we'd appreciate your feedback. I'll remind you all at the end too, but there is a button. There's a button for questions and a button for feedback down below the screen there. So I'm going to kick us off, as I say. So Sean, the new accounts rules, if we can still call them that, probably not, were introduced in 2019 as part of the SRA standards and regulations. It was quite a significant change. So perhaps, Sean, could you just remind us about the main differences in the accounts rules? Thanks.
Yes, of course. Good morning, everyone. So we, as Liz inferred, there's 3 years to this month that the new rules came into force. What we did with these rules was really start with a blank piece of paper and try to focus on the main areas of concern. I think previous versions of the rules just added on additional rules over and above the previous ones, and they became quite convoluted and difficult to follow, I think it's fair to say. The main difference, if you look at the 2019 rules, is that they are far shorter than the 2011 version, probably around a third of the size, and hopefully a lot easier to follow, especially for firms who are just entering into the legal market or solicitors who are trying to qualify to become solicitors. I think it's fair to say they're far more outcomes focused than they were previously. There's much less prescription in the rules now. So whereas we used to have things like 2-day rule or the 14-day rule, we've now got terms like promptly or appropriately, and it's up to firms themselves to determine how they interpret those terms to best suit the business needs while still focusing on clients' best interests and what's the right thing for them. We also, in these rules, have formalized the use of third-party managed accounts. So that's another way of holding client money, and the advantage of using a third-party managed account, or TPMA, is that any money held in those accounts does not count as client money. So if you're looking at whether your firm needs to have an accountant's report, I'm sure Janet won't mind me saying this, is you don't need to include the balances in any third-party managed account when looking at the exemptions that we've got for the need to have an accountant's report. We also, along similar lines, to try and remove the regulatory burden from firms, we introduced an exemption for the need to hold a client or have a client account at all. So Rule 2.2 of the accounts rules details this exemption. So basically, it's where a firm will only hold money on account of their own costs or for disbursements for which they are liable. If that's the only money that a firm holds on behalf of clients, then they do not need to have a client account at all. So again, be no need for the firm just had those types of monies to have an accountant's report. Again, so hopefully reducing the cost of regulation. We do still have a focus, though, on the high risk areas, and we have still been prescriptive around that. So things like having to have a client account reconciliation at least every 5 weeks, that is still prescribed in those new rules because it's such an important control and an area that would highlight any issues that there would be with our firm handles client money. And we also hope that with the new rules and the more outcomes focused way they are framed, is that it would align far better with the work of the reporting accountant. So back in 2015, we changed the way the reporting accountants needed to do their work, and they focused on the higher risk areas. Now we believe that the accounts rules also reflect the same types of concern that a reporting accountant would need to look at. But I'll pass over to Janet to see if she would concur with that.
Yes, Sean, I definitely agree with that. We went from having, again, alongside a load of prescriptive rules, a sort of checklist of things for reporting accountants to do, which unfortunately, I think some approached as if it were a tick box as well. I'll do this and so on without really thinking about it. And certainly what's happened since 2015, and then particularly with the rule changes in 2019, has been a shift by us as reporting accountants to evolve and develop our own testing, our own understanding of the rules, and make sure we are focusing like that. So I think, that's, there's probably some way to go for some firms, but I think we're broadly there. In terms of maybe other comments I'd add as well to what Sean's already said around the rules is, in terms of changes, the Rule 10, I think, is a key one, and, certainly has taken on increased significance. The rules previously, perhaps, certainly didn't really bring scenarios where the solicitor operated a client's own bank account as signatory into the rules in any great detail. Those things were sort of largely outside the accounting function, but the recognition now that firms needed better accounting records, better systems and controls to look after that money, being introduced in Rule 10 as another key area that we've been looking at. And then I think the other thing I would add is, again, particularly aligned to what Sean was saying, where these rules have moved away from being a very prescriptive kind of one-size-fits-all set of rules, where firms, here's the rules, I follow the rules, that's it, to much more principles-based, outcome-focused ways of dealing with this, is that firms do really need to think about, for our firm, for our clients, how do we best ensure compliance and protect client money within the framework that we've got here. And therefore, my call always goes out to firms to say, you really do need to make sure, so for those who haven't as yet, and there are still some of them out there, if you haven't got and properly considered your own policies, practices, procedures for dealing with all of this, and haven't made sure that they're clear to all of your staff and to any external reviewer, then that is something that firms definitely should be doing. And again, they're things that will develop and evolve as experience with these rules, and in fact firms themselves change and maybe start doing work for different types of clients. So I think having proper written policies and procedures that are well understood within your firm is another key thing. And certainly as a reporting accountant, it's one of the key things that we would look at, because it's partly what we're testing you against. Are they reasonable in the first place? And actually, are you then complying with your own policies and procedures alongside the rules?
Okay, thanks. So Janet, I'm sure the pandemic caused some difficulties with the ability of reporting accountants to perform their work, and I was just wondering if those have been resolved now?
Yes, it certainly was an interesting time in so many ways, wasn't it? And of course, as we all remember now, looking back, not this that long ago, that there were different levels of lockdown, weren't there, at different stages? So stage one was no one could go anywhere or see anyone or do anything. And then that sort of changed a bit where we were able, for example, to go into clients' offices as long as there was nobody else there or there was distance and so on. So we were sort of working our way through that. One of the key things for us as reporting accountants throughout that is, whilst of course the SRA did have to be pragmatic and did produce some guidance to firms about, for example, perhaps reports might be a bit later because of all of this and some other areas. The reality for us as reporting accountants was that our role was to ensure that firms are complying as far as possible with rules to protect client money. So we couldn't sort of slip our standards and say, well, you can't test that, so we won't bother. We just had to think differently about it. So it was certainly an interesting time. I would say on the whole, the issues have been resolved and in fact have moved things forward and progressed things, perhaps in a way that may have taken 5, 6, 7 years if we hadn't had the lockdown, because of obviously the investment in IT. And perhaps firms previously would have been reluctant, even if they've been able to allow their reporting accountants to have remote access to their systems to do their testing. Obviously, it became necessary. It became a vital part of being able to do this. So, yes, we've worked on that. We are now able to do more of our testing remotely, which is brilliant. But I think that one of the things that I would certainly say is that once we were able to go back into firms' offices, we did. And certainly most of the reporting accountants I speak to, and certainly those who've been doing this for as long as, or as nearly as long as I have, are very clear in their own mind that there is no substitute for actually going in and visiting a law firm's offices. So whilst we can do a fair amount of the work remotely, and probably in practical terms, could do nearly all of it remotely, it's really important that we do come in, that we do see the office in operation, that we are able to talk face to face to people, with people. I think that is a really important aspect of all of this. And I think that although we have found in some situations firms are a little bit reluctant perhaps to have us back, who knows why they're reluctant to have us back? I think we linger for too long, or we drink too much coffee, or whatever else it is. I think actually it's really beneficial for the firm because it can be a lot more efficient, a lot speedier to deal with queries and questions. Also we're there on site, so if people have got particular questions there and then, they can ask us. And I think it's just very good for the relationship between the reporting accountant and the firm. So, we're certainly hoping that firms won't sort of shut the doors on us going forward, but that we can make the very best use of the technology. And that has also helped us evolve, along the lines we've already been saying, our risk-based approach to the work that we're doing. So interrogating the system to make sure we're testing the right areas. So I think all of that ultimately has been to the good.
So a plea from you to please let the reporting accountants back in, and you won't drink all the coffee.
We won't drink all the coffee. We might eat all the biscuits, but we won't drink all the coffee.
Okay, lovely, thank you. And Sean, what are we now expecting, the SRA expecting from firms around the submission of qualified accountants' reports?
Yes, so Janet alluded to the guidance that we put out at the start of the pandemic, where we did try and give some leeway to firms who were struggling to meet the deadline for submitting reports to us, which is 6 months after an accounting year end. That guidance has been removed now, and we do expect firms to submit reports on time to us now. Just a reminder that it is an obligation of the firm themselves, the law firm themselves, to submit the report to us. There is an ability for accountants to submit reports on the firm's behalf, but if anything goes wrong, it would come back to the law firm themselves, and they would be the ones who'd have to answer any questions about the late submission of reports. And for both the law firm and the accountants, that can be done through My SRA. I think there is a little bit of an issue around when accountants submit those reports, in that they don't receive an automated acknowledgement that comes through. So the law firm, though, is able to check that it has been done on their behalf. So I would urge firms to do that in those cases. So those reports that are coming through late now, they can lead to regulatory investigations as to, especially if they're significantly late. We do place a great deal of reliance on the work of the reporting accounts and making sure that firms do engage accountants when they should be engaging them, and that they do submit qualified reports to us. It's still only qualified accountants reports that need to be submitted to us at the year end, but it's obviously better to submit a report late than not at all. But we do expect now firms to be getting those reports in on time and to have overcome any issues that there were during the pandemic.
Okay, thank you. And are we expecting to see any changes in the rules moving forwards?
So we had a significant change in 2019, as I said earlier, and we did, as I say, started with a blank sheet of paper. We don't envisage any significant changes imminently, and the feedback that we're getting is that those accounts rules have landed quite well. They've not caused firms any particular difficulties in having to change systems or processes in order to comply with the new rules, and they are enabling innovation within the legal market as well. So they seem to be working quite well. We have identified a number of, I'd say, fairly minor issues, which I think will be addressed when the rules are revised. Whether that's probably looking at some time next year. We've already put out some guidance around rules 2 and 4. And I think we'd expect to see the new rules addressing the issues in that guidance, so we can remove the need to have guidance around those particular rules. So that's about how and when firms take costs or transfer money from client account for their own costs. So we'd expect some changes along those lines. Janet's already alluded to Rule 10, which is solicitors operating a client's own account. So again, we've issued some guidance around complying with that rule, and we appreciate that in practical terms, it can be difficult for firms to comply with the requirements around reconciliations of those monies. So we'll be looking at, again, amending Rule 10 to reflect the guidance that we've got in place at the moment. So hopefully we can remove the guidance around Rules 2, 4 and 10. And we will also, I think, it's not the rules itself, but we'll also be looking to update and perhaps bring in more examples around Rule 3.3, which is using client account as a banking facility. So that's an area which can cause firms some practical difficulties, and obviously they don't want to fall foul of that rule. So we'll try and update for some of the scenarios that we're seeing coming through our ethics helpline.
Okay, thank you. Janet, what are the main issues you're seeing at firms?
Well, I guess we've got a few different areas, unsurprisingly, perhaps. I mean, I mentioned Rule 10 earlier on briefly, and certainly one of the issues has been, and Sean mentioned, it can be practically difficult for firms in certain circumstances to fully comply with that in terms of doing full reconciliations on all those accounts, particularly if somebody else perhaps is also operating, if the client themselves is operating the account and so on. What we have found, though, is that there was some reluctance early on by some firms to maybe accept the need for this. That certainly, having said that, if a firm's ever had a problem with this, it's a real once bitten, twice shy, and they've tended to have really good systems and controls in place. So we've been helping firms on the basis of you really need to get this further down the line than perhaps it started off being. So where firms just didn't have this area of their practice where they were operating clients' own accounts under any sort of other scrutiny beyond the person who is dealing with it on a day-to-day basis, the fee earner, the partner, for example, to bring that much more into their own internal sort of scrutiny and their own internal accounts function. So at least for review, at least for ensuring that there is a proper record kept of all the transactions that they initiate, and really sort of picking up the wording that's in the current guidance, which still remains important, that they've got to ensure, or they've got to satisfy themselves that that client money is protected. So having proper controls and so on in place. So a lot of firms have gone from 0 to maybe, 85% of what the rule itself currently says, but probably 85% with good systems and procedures is going to be as good as they'll be able to get, which, is what we've helped them work towards. In terms of the other issues, I guess, around some ongoing problems and some problems that perhaps we thought had gone away and now start to manifest themselves again. There's probably 5 areas, I would say, whereas reporting accountants, if we're going to qualify, we are more typically qualifying our reports. And in brief, those are around client account reconciliation problems, residual balance issues, Rule 3.3, which has been mentioned, the existence of client debit or office credit or business account credit balances. And so one that sort of seems to have slipped in a little bit again, the misuse or the overuse of suspense ledgers or sort of types of general ledgers. So maybe just picking up a bit more detail around those. In terms of the client account reconciliation issues, I think that obviously you've got extreme examples, which I know Sean will have seen some as well, where you get there and there isn't a client account reconciliation or there's no evidence of any anyway, which obviously is straight reporting as far as we're concerned, and certainly probably whistleblowing, because do remember, if you're a corp or a COF, your reporting accountant does have a duty to directly report to the SRA without first consulting you if they think there is something, really, really serious. So we wouldn't be waiting for 6 months after the year end. So there can be extremes. But I think more of what we're tending to report on is around sort of persistent and consistent weaknesses around client account reconciliations. I'm not saying these are widespread, but there's more of them than anyone would hope there to be. So it can be that they're just not prepared on a timely basis. It's a key control. Until that reconciliation is done, you don't actually know whether or not everything balances, if the money that you actually hold in your bank account is enough that belongs to all of those clients. So is it complete? Is it accurate? So they have to be done on a timely basis. And there's no reason in virtually any firm now, whether that isn't a matter of days, after the month end, with the sort of technology that's available. It's not like old manual systems or something. Sometimes there not being a full 3-way reconciliation, so not properly reconciling through from all the bank account statements through to the cash book, to the nominal, and to the list of credit balances on the ledger. But often or including debit balances as well, so not showing a shortfall. So it can be the reconciliation itself is not quite up to standard. But I think the other issue that maybe in some respects is even more of a concern to us when, in terms of its prevalence, say not massively prevalent, but more of it than I'd like, is a weak review process. So, either again, it not being done on a timely basis. Sometimes I actually even see people doing batches of these. So they'll check 3 months of them in one go, which is really not doing the job properly at all. And it's hardly taking it seriously. Not really recognising and showing any evidence of following up differences, and they remain unresolved. And as I was saying to the sort of the group we were talking to last week, it's a proper job reviewing the reconciliation. It's a proper process to go through. If you're the the person signing off on this reconciliation, you need to be thinking about the process that you go through to make sure you have fulfilled those obligations. Could you explain to Sean or one of his team, if they asked you, how you checked the reconciliation? Could you explain that reconciliation? So those are some of the things we're seeing there. Residual balances, I would say that the issues are twofold. One is just lack of robust systems and controls in place to ensure compliance with Rule 2.5. So avoiding residual balances in the first place. So that's the requirement to pay the money back promptly following the conclusion. And it is absolutely clear when you go out to firms, if they take that seriously, whether it's carrots or sticks that they use with fee earners to get it taken seriously, but they have proper written policies as to how quickly matters need to be closed down and how quickly funds need to be repaid to clients. They are firms that have far, far less issues with residual balances going forward because it's just properly dealt with and done and dusted. So the first issue is not dealing with a balance at the end of the matter appropriately in the first place, which then leads into having residual balances. So they might actually be ones that are relatively recent, the last sort of 2 or 3 years, but also you've got the issue of much older residual balances. So what a lot of reporting accountants have been doing over the last 2 or 3 years is fundamentally giving firms that are otherwise perhaps, okay, a chance to make sure that they're getting on top of these, that they can evidence improvement, that they are working through them, they're applying to the SRA for permission to pay them to charity if they're more than £500. But they're going through what the guidance says and dealing with those. But unfortunately, we're still seeing too many circumstances where firms just can't evidence that's what they're doing. Or they had a go a few years ago and then just threw their hands up in despair and didn't go any further. But they're a high risk area if they're left there. So we were seeing this year perhaps more reports going in where it's been you've had 2 yellow cards and, we're not seeing the improvement. So the report's gone into the SRA or the qualified report's gone in. So again, just getting on top of those, making sure that you're not falling foul of those aspects. Rule 3.3 I mentioned. So certainly issues around that. So why do breaches of Rule 3.3 arise? Well, either a lack of understanding of what the rule's all about and actually how easy it is to fall foul of it. Assumptions by people that what they could do 10 or 15 years ago, they can still do now, and they can't. And a desire really to help the client. And everyone wants to help their clients, but you have to be very careful about this. You have to understand at the outset what you are and what you're not able to do and manage the client's expectations as well. Because I would say in nearly all the circumstances I see where people have been in breach of Rule 3.3, it has been because they have been driven by a strong desire to either help their client or not upset their client. And the only issue then is if you've breached Rule 3.3, you've brought the problem down on yourself. So yeah, certainly issues around that. I suppose the other thing that I would say there is that the main breaches that we tend to see are paying inappropriate gifts out of proceeds to, let's say, family members, retaining funds on matters where the matter's been aborted or it's been completed some significant time ago. So issues like that, really, or paying unrelated liabilities on client matters. Client debit and office credit balances, clearly client debit balances shouldn't exist, but not properly dealing with those is an issue. The one that often concerns me more are the credit balances on the office side. Fundamentally, where firms don't have proper systems to ensure whether those credit balances are actually appropriate, because you can have legitimate credit balances in the business account, but there's not many reasons why they would be appropriate. Prima facie, they're always saying, oh, you've got client money in the office account, in the business account. So properly reviewing those and ensuring that if it's money that's inappropriately in the business account, it is transferred into the client's account, because it won't show up on a client account reconciliation as a shortfall, but fundamentally it is a shortfall. And then, sorry to take up too much on this, but the last one is just the misuse of suspense ledgers. So I think that there's been perhaps a little bit of a hangover from lockdown, and maybe where communications were more difficult between fee earners and the accounts team, and the way people were working in terms of the times, people working at different time frames in different parts of the day, and maybe messages not getting through, those sorts of things, maybe systems not being, again, as robust because of people working remotely. Has been probably scenarios where there were a few more situations where unidentified receipts were coming in and account staff were using suspense ledgers to allocate those to initially before they could actually resolve them. And I think there's still a bit of a hangover of that. I see more than I would have said I'd seen 5 years ago, scenarios where there are what I would say are too many unidentified receipts, or just a bit of a easy way of dealing with this for now before we sort it out. So misuse of client ledger in that respect, not getting things onto ledgers perhaps as quickly as they ought to be. And in worst case scenarios as well, when money's been sitting on a suspense type ledger for any length of time, some worst case scenarios are then payments being made directly from that suspense ledger, which would be entirely inappropriate. So those are probably the 5 areas where we've seen, issues that have led to qualified reports, and some areas where, we'd certainly want to see firms tightening up their procedures and controls.
Great, thanks. So I've had quite a few questions come through about Rule 3.3. So you've touched on it a little bit already. So the use of the client account as a banking facility. Some of the questions are quite specific scenarios, which I probably won't read out now because they're quite complicated. But there is a plea just for additional guidance. It says, can you provide more guidance on you must not use a client account to provide banking facilities? And I just wondered if there's any particular things you'd both like to draw out on 3.3 to help those that are asking these questions today. Thanks.
Well, could I probably just, I think, refer people to our website, which is, I think it's got some really good guidance on there around 3.3. And it's got in there some real life scenarios as to when firms could potentially fall foul of the rule, and what is permitted, what is perfectly legitimate way of using client account. So the reason we've got the rule is that solicitors are able to hold client money to facilitate a legal transaction. So that's, I think, the main thing that you need to have in your mind when you're deciding whether or not to receive money or who to pay money out to. We've seen examples more recently, and Janet will have seen this as well, of where firms are effectively paying money out or receiving money just for the convenience of a client, or because they are unable to open a bank account themselves. And that is exactly the scenario that firms should be avoiding, because that is the definition of using client account as a banking facility. You're there passing money through your account just because someone else can't open an account. So that's fairly obvious that would be a breach of Rule 3.3. There are some more nuanced examples, or where firms have retainers that have been going on for many years, and perhaps around holding commercial rent deposits, which is, I'm sure, is one that Janet would see. And again, there's some, I think, fairly good guidance on our website around that. But it's really to avoid the mischief of firms being involved in areas that they shouldn't be, when there's actually no need in terms of them facilitating a legal transaction to be involved. Janet wants to add anything.
Yeah, I think what I said, one of the messages that I've been trying to get across to firms, and I know it's something you've mentioned as well previously, Sean, is really trying to get across to fee earners the thinking about this at the outset of the transaction, because so many of these scenarios, I get phone calls from clients, late on in the day saying, actually, urgent query, banking facilities, and it will be a scenario where, as Sean said, they'll say, well, this is who we're instructed by, but they also own this other business, and that other business hasn't got a bank account, but now this money needs to be paid out and it needs to be done tomorrow. What can we do? And I'm going to say, hands on, I just sit there sometimes in despair thinking, I don't know what magic wand you think I've got. Me saying, oh, don't worry if they haven't got a bank account, you can do it because it's desperate now. People should be thinking at the outset, look, how is this transaction going to progress? And certainly learning from any experiences. How is this transaction going to progress? Ensuring that where the funds are going to come in from, where they're going to have to be paid over to, and that's paid over to in the context of the legal transaction, not just for somebody's convenience, and establishing with that client an understanding that, well, there'll need to be a bank account. This is who we've got to pay the funds to. So the expectations, again, are managed at the outset rather than this sort of crisis point that hits. And I think, again, another thing that a lot of firms I'm seeing in firms that are, I know all firms take it seriously, but taking it very seriously, is think about your different practice areas. So where is it tends to rise for you? So where you've got commercial transactions where clients have got, different entities they set up, it's often the bank account issue like that's the problem. But where firms do a lot of work where they're acting for trustees and as trustees, understanding the distinction between those as well. So when you act as a trustee, the rules define money you receive as a trustee as client money. So therefore, you've got a far, far wider accepted level of funds or type of funds you can hold and payments and so on you can make, because it's all in the context of you acting as a trustee. When you're acting for trustees and that one step removed, you have to be a little bit more circumspect about what you're receiving in and why you're receiving that in. And there'll often be scenarios where there should be a bank account held by the trustees rather than going through the firm's client account. So I think it's just thinking it through, thinking about the scenarios, planning ahead, talking to the client at the outset rather than having an annoyed client later on down the line. I think, as Sean said, and really making sure that people understand that guidance that is there available on the website, and any sort of further developments there are around that. So yeah, it's definitely the one I get most questions on, without a shadow of a doubt.
It's worth thinking. I mentioned earlier around we permit now the use of third-party managed accounts. Again, this could be a solution to that problem as well. It's not defined as client money if you've got money in a TPMA, so you might consider using those in the circumstances to avoid falling foul of Rule 3.3. It can be quite a complicated area, and I think we are getting more queries through to our ethics team around especially special purpose vehicles, SPVs, that perhaps don't trade, and because of that they haven't got a bank account and can't get a bank account. But it's important to try and, as Janet said, get these details at the start of the retainer. If you're going to have to pay money out to that company or receive money from that company, and they are the company you're acting for, they need to have some means of making that payment or receiving those funds. So either a bank account or a TPMA or something like that for you to ensure you are acting for that client and not using your client account inappropriately. And I think we are looking at how we can update our guidance to try and reflect some of those scenarios that we're seeing coming through, and there's work going on now to do that and make sure we've got as many practical examples on our website as possible to help people.
That sounds good, because certainly judging by the questions that are coming in, this is definitely an area where
Janet's favourite.
guidance would be helpful. Yeah. There's one here, and Janet, you said earlier that you thought law firms were just trying to be helpful, actually, and I think there's an example here. It says, we're often asked by clients to send money to children's or relatives for sale proceeds. Our understanding is that would be acting as a banking facility, but please confirm.
I would confirm.
I would confirm too, yeah.
And it's one of the most common, when breaches happen, before people learn what they're not supposed to do, that's probably one of the number one ones on the list. Yeah, you're only doing it for their convenience. There's no reason why the person couldn't and shouldn't receive the funds themselves and then pay them out directly. So, yeah, I don't think there's any get out of jail free card on that one.
And you've got to think what firms could potentially,
yeah,
how they could be falling foul, or how they could be being used. So a matrimonial is a good example of the type of case where payments the solicitor might be asked to make certain payments or hold certain money to try and frustrate the divorce proceedings and keep things away from those court proceedings. So you don't want to be dragging yourself into issues like that by using your client's account in that.
Okay, and another example here. A firm is taking upfront funds from clients for their visa application fees. The funds are used to pay for the Home Office visa fees a week later. The firm does not operate a client account. Is this an unlawful practice?
So can you repeat the question again, please, Liz?
If a firm's taking money to pay Home Office visa application fees, they take the money in, they hold it for a week, and they pay the fees later, but they've not got a client account. They're just holding it in their own account.
I'd say that those fees should be paid direct to the Home Office. It's not, if they're holding that money in business account, I think they'd be falling foul of those rules, because they're not liabilities for which they're not something which the firm will be liable for. So it doesn't fall within the Rule 2.2 exemption. So that should go into client account or be paid by the client direct to the Home Office.
Okay.
I think so. The other thing I was going to add into that was, I think because the rule says you mustn't use your client's account as a banking facility, sometimes people say, well, if it just all went into the business bank account, is that all right? But the principle is you shouldn't be really providing banking facilities per se, whether that was, even through your business account, really. It's a sort of a slightly different issue, but it's in principle, it's the same issue, isn't it, really? Get yourself in trouble in other ways.
Yeah, brilliant. Thank you. Okay, Sean, so I was just thinking a little bit about when your firms are out on visits, and just wondering if the sort of types of issues that Janet talked about earlier, the issues that she sees as a reporting accountant, are the things that you see when your teams are out on their visits?
Yes, they very much resonate with the types of breaches that we'd be reporting in our forensic investigation reports. It's probably worth just mentioning some of the interrelationships between types of breaches that Janet mentioned. So a firm that has problems with dealing with residual balances may also have problems with suspense ledgers as well. So what can happen is those old balances can be cleared off onto a suspense account and left there for years on end sometimes. And obviously that can cause problems, because it's far more difficult to trace who the money belongs to when it goes into a miscellaneous ledger. But it's also then highlights the risk involved, because that balance builds up over time, and the longer it builds up for, the more likely it is that someone's going to think, well, if no one's missed it for this long, then they're not going to miss it going forward, and it can become a temptation then. So it's important to be mindful of what risks that can be around suspense or miscellaneous ledgers, certainly. In addition to the areas Janet mentioned, we also are seeing issues around compliance with the money laundering regulations, which obviously it's clear that a client account can be used for washing the proceeds of crime. It will often fall foul of Rule 3.3 as well. And along those lines, again, use of client account, we are still seeing firms who are or have involvement with dubious investment schemes. Again, we've got some extensive guidance on our website about the types of red flag that there are for those investment schemes and the types of questions you should be asking if you're asked to act in a matter that bears the hallmarks of a dubious investment scheme. And we're also starting to see firms, not many at this stage, but a number of firms who should have had an accountant's report and they haven't done that. So we do have exemptions, which again, those are detailed on our website, where firms, for example, don't hold more than £10,000 of client funds, and it doesn't go higher than £250,000. They don't need to have an accountant's report, but for firms that do, it's very important that they do engage an accountant. And if we see firms who've clearly just abdicated their responsibilities in that area, that is something we would take very seriously as a regulatory matter.
And on the subject of accounts reports, you said earlier, better late than never. So, you know, that now the pandemic is sort of past and we're getting back to normal, that, well, hopefully that that they should be submitted on time, but better late than never. So I've had a question here which actually says, are there any reprimands for retrospective submission of accountants reports?
Well, we would look at the circumstances surrounding why it was late. So we've got our enforcement strategy, which is again detailed on our website. And we look at the types of factors that would have led to that report being submitted late. So we'd look at perhaps whether reports have been late previously, how late it was, the reasons why it was late. So all types of factors like that before we decide on what action will be appropriate to take in a regulatory terms. So it's not clear cut, but we see a number of cases where we have looked at firms who've submitted reports significantly late. You know, a day or two or a week or two with good reason isn't too much of a problem, but if someone's 6 to 12 months late and there's no good reason for that, then we'd certainly be looking at actions required.
It's still better than not at all.
Yes, definitely. I mean, not at all is either not submitting a qualified report to us is a problem, or not engaging an accountant when you should is also just as much of a problem.
Okay. And another one here, Sean, do accountants reports need to be submitted once a successor practice has taken over?
So a good question. We don't normally require, so there was a requirement previously for any firm who changed the legal status or became a successor practice to submit a cease to hold report. We don't require that now in all circumstances. We would ask when a firm needs to submit a cease to hold report. So it's not required unless we ask of that. So normally when it's a successor practice, we wouldn't require that report to be done.
Okay, thanks. And in terms of the qualified accountants reports that are submitted to us, what sort of themes are you seeing, and perhaps a bit of a picture of what comes through to us?
Yes, sure. So we, as you mentioned in the intro there, Liz, we do review in our forensic investigation teams, we do review every single qualified report that comes through to us. And just looking at the latest figures, what we have seen is quite a significant reduction in the number of reports that are coming through to us. So in terms of calendar years, in 2019, we received 979 qualified reports, and that was down to 587 in 2021. So it's a 40% reduction in numbers, and that's probably what we would have expected, because we're asking accountants to now focus on those higher risk areas. And we used to get far more qualified reports because of what we call technical breaches. So things like the 14-day rule, where firms hadn't transferred costs from client account to the business account within 14 days, would, under the old regime, have been a proper qualification, whereas we wouldn't expect accountants to qualify now. So we are seeing lower levels of reporting, but still, when we do get those reports now, they are of more value to us, I would say, because they are highlighting those greater risk areas, which is good, and why we value those reports so much. And I guess to highlight that, in 2021, we took some sort of action on 13% of matters of those reports received, whereas that was down at 6% 2019. So it's probably where we'd expect things to be moving, in the way that we'd expect things to be going. In terms of what we take action on unqualified reports, there'll be some overlap of the issues Janet outlined earlier, which you'd expect. So residual balances, suspense accounts, poor control environments, or unreliable books of account, reconciliations not done or done late, and also client account shortages, which is probably the last one I mentioned, but probably the most serious. And certainly if we saw a report from an accountant which detailed a client account shortage, especially one that hadn't been replaced, we'd certainly be looking to take some sort of on-site investigative action. In those cases, we'd always expect a shortage to be replaced as soon as the firm became aware of it, or very, very shortly afterwards. Also seen instances, which these are probably on the less serious scale, of, as we've said before, late reports, reconciliations not signed off, reconciliations being performed late, and again, issues around qualifications on Rule 3.3, where firms are holding rent deposits when they shouldn't be, and that would normally be some sort of desk-based investigation.
Okay, thank you. So your top 5 and Janet's top 5 are pretty similar. So lots of good guidance there, things to keep an eye out for.
I didn't know. I didn't know whether it was just worth adding again, so people are aware of it on that. Because one thing Sean referred to as well was, poor control environments and unreliable records. Certainly, one of the things that I come across quite a lot, and a number of the areas where I've either, or colleagues and people that I deal with qualified on, is where we might, as reporting accountants, remember we focus on risk, have not necessarily found any individually significant breaches of the rules, but quite often, and Sean will have seen them, we might do quite a narrative type report around problems that there are more generally in the firm, and often it's from experience. You just think these, whilst I haven't seen clients losing money as such, for the size of firm, the type of firm, the clients that they've got, this just doesn't seem to be, this to me is not as good as it ought to be. So it's not about perfect, but it's about that perhaps there are weaknesses and lacks of controls and so on. I mean, to be honest, I have almost, hand on heart, I've almost on occasion sat back and thought, I'm not really that comfortable with this. I haven't seen any horror story here, but I'll sometimes think, would I give them my money? I sit there and think, do you know what? No. Then I realise I've got to think very carefully about whether or not that firm is really operating its accounting system as it should be. So I just thought that was worth giving people a flavour of some of the reporting accountants' thinking.
It's probably worth flagging as well with that, Janet, that we do have some, again, on our website. There's some examples of control of areas of risk, and then the controls that firms can or should be applying around each of those areas, and it's sort of a traffic light system, red, amber, green, as to what are good controls and where firms may need to tighten up in particular areas.
Yeah, and I definitely flag that. I mean, it says again, it sort of says for reporting accountants, but any corp or coffer, anybody in law firm, it's absolutely as relevant to you, definitely.
So that overall control environment is really important. Okay, so I've had a lot more queries on Rule 3.3, clearly the popular one today, and some of them are really quite specific. So perhaps it's worth just saying to those with quite specific ones that have a look at the guidance, and you can, of course, call the ethics helpline if you've got a specific question. But Sean, you did mention that the guidance is being updated, so I didn't know if you wanted to just again draw attention to that so people can take a look and hopefully find the answers there.
Yeah, sure.
Yeah, absolutely. And then another sort of theme that's coming through is around interest. And I think in the current economic climate, are you seeing any issues around Rule 7 around paying interest?
So not yet, but it was only a couple of years ago that we were talking about what may happen if we have negative interest rates. So it used to be, I've obviously been the SRA and Law Society for a long time now, and it used to be when I first started that it was a big issue in terms of whether or not firms were accounting to clients for interest in accordance with the rules that we set, because we were very prescriptive about how much interest was due to clients. Now, the change now is that the emphasis is on firms to have an interest rate policy, and they should be very upfront with the client at the start of the retainer as to what that policy is. And the important thing then is to make sure you are applying that policy for any client money you hold. And basically the need to have that set that out at the outset allows the client to make an informed decision as to whether they will engage the firm, and if that's something that's really important to them and they don't like the interest rate policy that the firm has, then they can walk away. It's up to you, the firms, as to how they set the interest rate policy and what's reasonable, but they need to be very transparent at the outset with the client. Say, make sure you are applying those rules. And we had a question at the session last week as to when you normally account to clients for interest, and we'd normally say at the end of the retainer was the easiest way to do that. Then you know exactly how long you've held client money for that particular individual, and you can make those calculations at that stage.
Okay, thanks. One of the things you said right at the start when you were sort of highlighting the changes in the accounts rules was that it's much less prescriptive and it's sort of left a bit more to judgment. So there's a question here, and it says, the rules say you ensure client money is returned promptly to the client, and it's asking for more guidance as to the word promptly. So where we're not a prescriptive now, how to interpret some of those words?
Yeah. So, do you want to start with that one?
No, all I was actually going to say was that, I mean, there's no absolute, is there? I mean, I tend to look at this as a sort of almost with an auditor type hat on, and an expectation from there, which is, I would expect a matter to be closed down, certainly within a month at worst, really. I just don't see why, apart from anything else, the longer you leave it, the harder it gets. But in that document that we referred to, which is the I think it's called Preparing for and Completing an Accountant's Report, which has the traffic light system. It does actually make the point that, once you're getting beyond sort of more than 3 months, you're getting into, territory where how's that promptly, and it will be a different definition. But that document does pick up. It doesn't give you timelines, but it gives you a good sort of benchmark around what might be expected. But I would say if I'm looking at as a reporting accountant, I'm starting to get a bit angsty at people if they're not dealing with these, within a month, say, and certainly within 3 months, even if there's some sort of, issues perhaps to resolve on that. But yeah, sorry, that was a little jump in.
I'd echo that. And, the longer it goes on, the file closure procedures are really important to be tight on that. So you'd expect, within a month to try and make sure that your client and office or client and business account balances are zeroed off. All money is paid to clients. You've billed any costs that you are due, and before that file goes in the cupboard, whether it's an actual cupboard or an electronic cupboard, everything should be zeroed off, and no one hopefully needs to open that again unless something unforeseen happens.
Okay, thank you. A question here from JB. If you have qualified reports for a number of years with the same issue highlighted for one firm, will further action be taken? And another request for specificity here. How many years would be seen as too many times?
So yes, we would look if there have been multiple breaches over a number of years. Now, I think that's probably changed more recently with the new rules and the way the reporting accountants work now, is that we shouldn't be seeing those technical breaches coming through if the accountants are doing the report properly, and we should be seeing things that are highlighting high risk areas. How many years? Well, it will depend on the types of qualification that there are. Obviously, there's still lots of reports that we receive that we don't do any further work on or lead to any regulatory outcomes. So it depends again on the nature of the breach, and we'd always apply our enforcement strategy to the types of breaches that we're seeing. So that would maybe help to answer that question a bit more if someone would, if you'd like to look at that again on time.
Okay, thanks, Sean. And I'm conscious of the time. I'm just going to maybe ask one more question, and this one for you, Janet. If you work on a fixed fee basis, when can you transfer money from the client to the office account?
This might be a longer answer than envisaged, but to be brief, I think the idea of fixed fee is a bit of a misnomer, really. The issue about obtaining and transferring money for the firm's fee is more about whether the question tends to be really more about whether or not you can take money in advance. So one of the rules or two of the rules actually that Sean mentioned that are sort of part of the consultation, Rule 2 and Rule 4. Rule 4 basically makes the point that where you've got money on account or you're going to be paid out the proceeds of the transaction or whatever, then you must deliver a bill or written notification of costs to the client or the paying party, and then that effectively becomes your money and you transfer it across within a reasonable time frame. Now, that talks about the costs incurred, which refers to the work being done. So you'd have to have done the work. However, there is also, under the definitions of the rule, an allowance where if you've billed the client for the work you're going to do, which would be in respect of what you would describe as a fixed fee, because if you haven't done it yet, then that can be held in the firm's business account. So there's a little bit of an anomaly between the two there, but actually that's covered at the moment in the SRA's guidance around taking money for your costs or transferring money for your costs. So if you have agreed a fee with a client and you've billed the client and you haven't done the work, technically you would be able, having fully informed them, to take the money, but you've got to consider the risks attached to that. So if, for example, the client now pulls out of the transaction, the money isn't in your client's account and protected, so you'll be able to pay them back immediately. If the transaction, for other reasons, is aborted, can you pay the money back? If something happened to your firm, if you're sole practitioner, for example, and had to close because of death of the sole practitioner, then how would the client get the legal services that they need in terms of money that's sort of been spent. So there's some really good guidance in that. So I think that's what you've got to think about. There isn't the same concept of agreed fee as there used to be. It's either you've done the work and you bill them, you take the money, or you're saying, can I take the money in advance of having done the work? And then you have to think very carefully about how you've communicated what the client has agreed to and the risks attached to that. So I think I would definitely point to where we are at the moment, look at the guidance on that, and it's actually quite detailed in that area.
Brilliant. Thanks ever so much, Janet. I'm really conscious we've had so many questions and we'd love to be able to answer them all, but I'm also conscious of everyone's time. So again, just directing you to the guidance on our website. There's lots there, for example, improper use of client account banking facility, which has got those case studies that someone's come in and asked about, the guidance that Janet just talked about. So do take a look at that. And also, if you keep an eye out for other webinars and things, which will also be coming up. So do keep an eye out for that. Can I just remind you about the feedback? We'd really like to know how this has worked for you. So please click on the link below and let us know. Also, just a bit of a flag for further sessions in our online conference this week. So if you go to the SRA events page, you'll be able to see. And indeed, if you subscribe to our YouTube channel, then you can get notifications through if you're really keen, and you can see what events we've got coming up as they go live. And I think all that remains is for me to thank all of you for listening, but particularly to thank Janet and Sean for answering all our questions today. Thank you very much.